Stock prices are on the rise or expected to rise. It's a good thing for your investment portfolio because there's potential for higher returns. Stock prices change every day by market forces. By this, we mean that share prices change because of supply and demand. If more people want to buy a stock than sell it, then the price moves up. Conversely, if more people wanted to sell a stock than buy it, there would be greater supply than demand and the price would fall. Understanding supply and demand is easy. What is difficult to comprehend is what makes people like a particular stock and dislike another stock. This comes down to figuring out what news is positive for a company and what news is negative. There are many answers to this problem, and just about any investor you ask has their own ideas and strategies. That being said, the principal theory is that the price movement of a stock indicates what investors feel a company is worth. Before we get into details about a few companies making headlines in the trading market, don't forget that we have a bonus fact for you towards the end of the video. Number 1. Poshmark. Shares of the second-hand fashion retailer jumped 17.46% after Barclays upgraded them to overweight from equal weight. The firm said it sees more than 40% potential upside for the stock, especially if consumers trade down in a recession. Barclays analyst Trevor Young raised his rating from equal weight to overweight, noting positive signs in the company's recent earning reports. He argued that its growing base of active buyers has reached a tipping point for the platform. Young also cited high engagement from social elements of the platform, secular tailwinds, and a benefit from customers trading down during a possible recession. Young raised his price target on the stock from $13 to $17. Poshmark probably would have jumped double digits on an ordinary upgrade, but this one came immediately after the stock fell 8.4% last Friday on earnings. The Barclays upgrade seemed to cause investors to rethink the quarterly results. Active buyers rose 14% to 8 million, but adjusted earnings before interest, taxes, depreciation, and amortization flipped from a $6.5 million profit in the quarter a year ago to a $9.8 million loss, showing the company is having trouble monetizing its user growth. Guidance for the third quarter was also weak, calling for a sequential decline in revenue to $85 million to $87 million and an adjusted EBITDA loss of $9 million to $11 million. Number 2. Disney. Shares of the entertainment company gained 2.22% after Daniel Loeb's Third Point took a new stake in the giant. In a letter to Disney CEO Bob Chapek, the activist investor said there is a strong case that sports network ESPN should be spun off. Loeb also called on Disney to accelerate integrating streamer Hulu. In a letter to Disney CEO Bob Chapek, Loeb said there is a strong case that the ESPN business should be spun off, saying the segment generates significant free cash flow for Disney. ESPN would have greater flexibility to pursue business initiatives that may be more difficult as part of Disney, such as sports betting, Loeb said. We believe that most arrangements between the two companies can be replicated contractually in the way eBay spun PayPal while continuing to utilize the product to process payments. Disney is making more money from cable subscribers than any other company solely because of ESPN. ESPN and sister network ESPN2 charge nearly $10 per month combined, while Disney requires pay TV providers to include ESPN as part of their most popular cable packages. ESPN Plus, a streaming service with limited content, has become a stronger product in the past year as Disney moves more exclusive live games to the service. Disney said last month it will raise the price of ESPN Plus to $9.99 per month from $6.99 per month starting August 23, the largest price increase to date. Number 3. Vroom. Shares of automotive sales platform Vroom shed 10.38% after JP Morgan said it's time to sell the company, which has shed more than 80% this year so far. The firm took a bearish stance on the used car industry as well, seeing it struggling in a potential recession. Several equities analysts have weighed in on the stock. Wedbush reiterated an outperform rating on shares of Vroom in a research report on Tuesday, May 10th. Stifel Nicolaus decreased their price objective on shares of Vroom from $2 to $1.50 in a research note on Tuesday, June 28th. JP Morgan Chase & Co. lowered shares of Vroom from a neutral rating to an underweight rating in a report on Monday. Finally, William Blair downgraded Vroom from an outperform rating to a market perform rating in a research report on Thursday, April 28th. One investment analyst has rated the stock with a sell rating, 5 have given a hold rating, and 2 have issued a buy rating to the stock. Based on data from MarketBeat, the company currently has a consensus rating of hold and an average target price of $16.28. Number 4. Bed Bath & Beyond. Shares of Bed Bath & Beyond spiked 23.88% amid a continued meme stock trading frenzy that's lifted shares of the retailer. So far in August is up nearly 180%. The latest retail trading activity comes from an amended 13D filing with the U.S. Securities and Exchange Commissions from RC Ventures, which is a venture capital firm owned by Chewy.com co-founder and GameStop chair Ryan Cohen. According to the filing, RC Ventures beneficially owns 9,450,100 Bed Bath & Beyond shares, or an 11.8% stake, including 1,670,100 shares underlying certain call options. The options, which expire in January 2023, were purchased at strike prices between $60 and $80. A call option gives the buyer the right to buy a stock at a given price for a fixed period of time. Cohen's position in Bed Bath & Beyond has not changed since RC Ventures amassed a 9.8% stake in March. Instead, the company has lowered its total amount of outstanding shares, making Cohen's stake a larger percentage. In a letter disclosing the initial 9.8% stake, Cohen called on Bed Bath & Beyond to narrow its focus to fortify operations and maintain the right inventory mix to meet demand, while simultaneously exploring strategic alternatives that include separating Bye Bye Baby Inc. and a full sale of the company. Number 5. Moderna. Shares of the biopharmaceutical company rose 3.2% after news Monday that the UK approved Moderna's updated COVID-19 vaccine. The dual vaccine, which targets both the original virus and newer Omicron variant, is expected to be available to adults as a booster in the fall. Moderna executives aren't the only ones who have benefited from the mRNA specialist's surging stock price during its work on the COVID-19 vaccine. AstraZeneca cashed in its entire 7.65% stake for about $1 billion, the British pharma disclosed in its annual report. It wasn't clear when in 2020 AZ made the sale. The revelation came weeks after Merck & Co. disclosed that it had sold off its direct Moderna holdings in the first half of the fourth quarter. Over the years, AstraZeneca invested $290 million in Moderna equity amid a slew of strategic collaborations, the U.S. biotech said in its own annual report. At whatever point AstraZeneca sold out last year, the company made quite a fortune. From slimming down its equity portfolio in 2020, AZ collected $1.38 billion, a large proportion of which related to the disposal of its full holding in Moderna, the British drug maker said in its annual report. Thank you for staying with us throughout the video. It's now time for the much-awaited bonus fact. On September 17, 2001, the Dow Jones Industrial Average, or DJIA, traded down 7.1%, which was one of the largest one-day losses the index has ever suffered. The huge market move was a reaction to the terrorist attacks against the United States that had occurred 1 week earlier. Which company do you think has a higher chance of moving up in the market? Comment your thoughts down below. If you enjoyed the content, uplift the channel by hitting like, subscribe, and ring the YouTube bell to meet us again in the next video. Until next time.